The housing markets of the United States and many other countries are on the brink of a collapse, potentially on a far greater scale than even the housing market crash of 2008, an event so monstrously large that it was deemed once in a lifetime. In a bid to hedge against the overwhelmingly high bursts of inflation, the Fed has continually raised the central bank's key rate by a substantial 5 percentage points in 14 months, the fastest pace of increases in 40 years. The intended effect, of course, to lower spending, cool the economy, and as a result, curb inflation. However, this has resulted in interest rates on 30-year mortgages doubling from 3.8% to 6.8% from March 2022 to today, making it more expensive for people to borrow and take out a mortgage. As a result, comparing to 1 year ago, sales of existing homes have tumbled by nearly 25%. High inflation, high interest rates, decreased housing sales alongside the collapsing of 3 US banks in less than 2 months, one of which used low-cost mortgages to lure in clients, has had the compounded effect of stunting economic growth and caused other banks to restrict lending to new mortgage takers. Many investors have started to believe that these factors are not just red herrings and are in fact warning signs, just as the truth was once predicted by Michael Burry in 2006. Other investors who shared this belief in Burry's prophecy have recently come forward and heeded their warnings. Such is the case with Dave Burt, who helped 2 protagonists of Michael Lewis's best-selling book The Big Short bet against the mortgage market in the lead up to the 2008 global financial crisis. And Burt now believes that there is a hidden factor which no one, the individuals, nor the financial institutions, nor the government want to acknowledge, which will crash the housing market in the time to come. And if you want to protect your wealth from this kind of crash, if you want to ensure you're able to make your investments perform for you, keep an eye out for Vaulted later on. But first, we need to understand how the market has fared leading up to this moment in time. Why does the housing market appear to be so overvalued? Well, on the 15th of March 2020, as COVID grounded the world to a halt, interest rates were cut down, making debt cheaper and mortgages cheaper as a result, more so than ever before. Simultaneously, many American families found their pockets lined with payroll relief funds from government stimulus packages and without any means to spend their newly found lined pockets. The effect was that Americans decided to lock themselves into larger homes at the cost of higher priced 30-year mortgages, either to enable themselves to gain a higher valued asset once the mortgage is paid off, or to create home office spaces since working from home became a normality for many Americans. Property values rocketed up across the United States. The average property price in Houston, Texas rose from around $250,000 in 2020 to almost $350,000 in 2022, and during that same time frame, prices in Boise, Idaho rose from $350,000 to almost $600,000. In 2020 alone, the US housing market rose to $36 trillion, gaining almost $2.5 trillion in combined value of homes, more than any year since 2005, which is coincidentally the year before Michael Burry uncovered the bubble within the mortgage-backed securities and centralized debt obligation markets. Over the last 2 years, the US housing market has continued to swell up to $45 trillion in combined value as of the end of 2022. While this unprecedented growth of 34% in the US housing market took its value from $33.6 trillion on January 2020, it looks extremely positive when viewed in isolation, but given the rest of the state of the economy in the United States, which faces high inflation and an almost certain recession, the housing market now appears destined to crash. We are starting to see the beginning of this, with CNBC reporting that mortgage demand fell by 13.2% during the last month of 2022. This alongside statistics that show on average that Americans are experiencing negative real wage growth 2.6% a year, and the S&P Global Ratings reporting that the leveraged loan default rate could rise to 2.5% by December of this year from 0.85% in the beginning of the year amid persistently challenging credit conditions, with the researchers stating that they continue to see evidence that cushions built up after 2020 recession are thinning for speculative grade issuers. Essentially, many mortgage takers are becoming stretched too thin, biting off more than they can chew, with the cost of living crisis rising due to core inflation and their mortgage costs becoming more and more burdensome, something which is resulting in the quickly rise of defaults according to top macroeconomic researchers. At the same time, due to increasingly high interest rates which are unlikely to fall in order to battle inflation, new mortgage takers will be few and far between and the market will fall apart, with prices finally correcting themselves after years of bubbling. Now we might be thinking, how does this relate to those at the top of society? Whilst high interest rates make investing in real estate much more difficult for the wealthy, new issues appear to be emerging for the rich which seem to be stunting the number of sales which occur within the US real estate market. New state laws like the California mansion tax, which came into effect on the 1st of April 2023, have been aimed to raise taxation funding for programs to combat housing insecurity. However, the new measure of taxation has only taken in $3.6 million in tax in its first month of effect, a far cry from the estimated average of $56 million a month in its first year. In fact, a state known for housing the super wealthy only had 10 sales which are eligible to face the taxation in April, despite 144 eligible sales occurring the month before the installation of that new bill. It appears that LA is off the table for the super rich, as sales in California have been tanked. However, given the revelations of Dave Burr, as we're about to get into, it's likely that the super rich will not just withdraw from investing into real estate in LA, but also New York, Miami, and San Francisco. But first, who is Dave Burr and what makes him so credible? So with everything going on, it really shouldn't be so surprising that millions of individuals are wondering whether they should be investing into gold as well, and that's where this video's sponsor Vaulted comes in. Vaulted is the best way for investors to acquire physical gold with a great website and mobile app that makes it easier than it's ever been. They store and insure their one-to-one allocated gold in the Royal Canadian Mint, and you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings whenever or wherever you desire. Their prices are the best in the market because they store all of their gold at the manufacturer and they cut out all unnecessary middlemen. They don't charge you any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. I highly suggest you check Vaulted out. There's a link for you down below in the comments in the description. Again, that's Vaulted in the link down below in the comments and description. Dave Burr, the CEO of investment research firm Delta Terra Capital, one of the few skeptics who recognized the real estate sector was teetering on the brink of collapse in 2007, and he was even depicted in the best-selling book The Big Short, and his presence is felt in the form of Brad Pitt, who plays his business partner and colleague Ben Hockett. The book, which follows the few who went against the grain, shorting the mortgage-backed securities and collateralized debt obligation market in 2006, foreseeing the impending financial crisis and crash and profiting hundreds of millions in the fallout of the financial crisis. According to Dave Burr and other experts, fallout from flood risk could result in a similar market correction to the events seen 15 years ago. Financial firms invested in mortgage-backed securities as well as individuals' homeowners are ignoring this climate hazard which could rock the entire market. With evidence for global warming and rising sea levels, the lack of concern and risk mitigating strategies or plans in place reflects a similar carefree and negligent attitude which originally led to the start of the largest financial crash since the crash of 1920, which started the Great Depression. If and when these market correcting events take place, we could become plunged back into the dark ages of the Great Depression, where unemployment and crime rose to all-time heights and shortages in all goods from food, gas, and clothes emerged. Dave Burr was quoted stating that his investment research firm calculated an aggregated loss of $800 billion in home value across the US in his base case correction scenario. Given that a study by the North Carolina State Center for Geospatial Analytics found that only 4% of homeowners nationwide have flood insurance. This is something that means that normal families with and without mortgages, whose largest asset is their home, will lose everything, plunging consumer spending and economic growth on a mass scale. But how plausible actually is this scenario? Well, it's currently estimated that more than 14.6 million homes in the US, or 10% of all properties, face substantial risks of flooding, with this figure expected to increase by 1.6 million homes by 2050. After factoring in that large cities like New York, Miami, and San Francisco, with a collective real estate market valued at over $5 trillion, lie just 10 meters, 2 meters, and 16 meters above sea levels respectively, the problem becomes evidently more realistic and likely, especially when also considering the current global climate crisis. Only less than a year ago, in August 2022, Pakistan declared a state of emergency as 10 to 12% of Pakistan became flooded and underwater. These floods were the worst in the country's history and affected 33 million people, destroying almost 900,000 houses and damaging another 1.4 million. The scale of devastation was enormous, and reconstruction costs to the developing nation are estimated to be at least $30 billion. This, however, has not been an isolated incident. In the same year, Nigeria faced its worst flooding in a decade, impacting an estimated 3 million people. Now imagine the devastation that would occur if these freak weather conditions were to hit a developed country like the US, and the impact would be incomprehensible. Alternative investment firms like Blackstone and Starwood Capital, as well as banks with large portfolios of MBSs, would also be likely to suffer catastrophic losses. Big names like Bank of America with $580 billion in mortgages, Wells Fargo with $280 billion in mortgages, and JP Morgan with $210 billion in mortgages all stand to lose billions, as many mortgage takers would be forced to default on their loan repayments, causing these investors to bleed money, their mortgage-backed security values being reduced to nothing. But not even the US government would be safe from this disaster, with the Fed reportedly owning roughly a quarter of the total MBS security market, or $2.6 trillion worth. Effectively, this threat wouldn't just wipe out $800 billion worth of value instantly lost. A greater shockwave effect would cause the collapse of not only some of the largest financial institutions previously mentioned, like in 2008, but it also might cause the first official default of the US government due to their heavy reliance on mortgage-backed securities, which make up 30% of the Fed's entire portfolio. The issue here is not that people and firms have at large invested in MBSs, nor is it that people are using mortgages to buy homes. The issue is that the mortgage market is massively mispricing the risk of flooding, and it isn't taking out insurance. One study from February of this year estimates that residential properties which are currently exposed to flood risks without regard for global heating are being overvalued by up to $237 billion. To quote the lead researcher from the 2023 Nature Climate Change study, Jesse Gourevich, in general, highly overvalued properties are concentrated in counties along the coast with no flood risk disclosure laws and where there is less concern about climate change. Low-income households are at far greater risk of losing home equity from price deflation. But this isn't just an issue restricted to American markets, this is a global one. Over in the UK, expected damages from flooded are estimated to be around £870 million per year currently, already placing a massive footprint on British GDP. And to make matters worse, all of the most densely populated cities like London, Cardiff and Edinburgh could see property damages caused by flooding increase by more than 25% as we go forward. Currently, approximately 10% of England's land area is located within flood zone 3 areas, the most likely category to flood. And more concerningly, of this 10%, around 6 million properties, or 1 in 6 homes, are at risk of flooding across England, according to our own government's data. That means that the impact to the British economy in such a scenario as the one presented by Dave Burt would potentially cause 1/6 of an all UK mortgage-backed securities related to these threatened properties to lose much, if not all of their value, a truly catastrophic event for the already struggling British economy. It's clear to see that flood risks are growing. We should listen to Dave Burt's warning and take flooding as a serious risk to the property market and try to price this into current valuations. But frankly, who's to say that we should stop there? That flood risk isn't the only risk. What about wildfires, which have more than quadrupled in England during 2022 and destroyed 246% more homes and structures in the west of the United States during the past 2 decades? The simple reality is that the housing market is on far shakier ground than many people had envisioned, and in order to protect ourselves from what's to come, we have to think about alternative assets, and my number one pick has always been gold. If you want to invest in gold like I do, then click the link for Vaulted down below in the bio, or if you just want to see how Blackstone are enduring a 7-month-long bank run, watch this video here.